introduction, as I think everyone of you already know him. Okay? Alright, good afternoon, Mr. Bollinger.
Hello.
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 Much better. We're going to spend a few minutes together here, and they told me that I didn't need to prepare a presentation for this session, so I don't have slides. I apologize, but I do know the answers to a lot of questions about Bollinger bands. So I'll start by answering a couple of the questions that are asked the most often. Even here at the IFTA conference, I have been asked these questions. So I just answer them once for all of you at the same time, and then you can ask me whatever questions you like. I will answer almost anything. Right? I live, first of all, one question everybody asks me is where I live. I live in Los Angeles, by the beach, somewhat near the LA airport. And my office is 4 miles away from my home. So most days I drive to work, but some days I walk to work if it's a beautiful day. So let's see. The first question that people tend to ask me is how I created Bollinger bands. And it's a pretty simple answer. They rose to fill a need. So when I started in this business, I started full-time in this business in 1980. I should answer one other question. I'm not dead. No, seriously, I'm not dead. And it really was me. I created Bollinger bands. It wasn't somebody else. So I started in the business in 1980, and we had a very simple trading system that worked very well. We used a daily chart of the Dow Jones Industrial Average, and we used a 21-day moving average. Now, in those days, we kept charts by hand, right? There were no computers. Well, there were computers, but they were big and they were heavy, and they didn't really keep charts. You get quotes on them and stuff like that. So we kept all of our charts and all of our charts by hand, and we kept all of our systems on pads with columns down the side. So we put the date and the price, and open, high, low, close, and volume. And then we calculate a couple of indicators. And we'll only calculate the simple indicators because we did it by hand. Right? So we didn't want to calculate anything that took a lot of, punching into a calculator or something like that. So for example, we used 10-day moving averages because you could just add 10 days and cancel the last digit, and it was the value of the moving average. So, and you wonder how we have these choices for like 7 and 9 and 14 for the different indicators and stuff like that. They're almost all because there was some sort of computational shortcut that could be involved so it was easier to calculate. So there's no magic like RSI, 9 period or 7 period or 14 period. There's no magic to those numbers. Those numbers are simply easy to calculate. There's some little rule of arithmetic that made them very fast to calculate with a pencil. So we had this chart of the Dow Jones Industrial Average, and we plotted a 21-day moving average on it. And we took that average and we shifted it up by 4% and down by 4%. So we had fixed width bands. We had an upper band, a middle band, and a lower band. But they didn't change. They weren't adaptive. They were fixed width. 4% above and 4% below. And we calculated two indicators. One from the number, both of these indicators were calculated from the data on the New York Stock Exchange, the number of issues advancing and the number of stocks declining. So we calculated one indicator from the advances and declines, and we calculated one indicator from up volume and down volume. So each day, we would, at the end of the day, we would look at the machine, and it would say that there were 1,200 stocks up on the day, 1,000 stocks down on the day, and 200 were unchanged. So we would calculate the advance decline ratio, and then we would keep a 21-day sum of that. And that was the first indicator. The second one, we do exactly the same thing for up and down volume. So we take the total volume of stocks that were up on the day and the total volume of stocks that were down on the day, and we would subtract the down volume from the up volume, and we keep a 21-day total of that. So what you had was a price chart with a set of fixed width bands and two indicators plotted underneath it. One advances and declines, the other up and down volume. And the rules were really simple. If price was strong enough to get up and touch the upper band, and one of those indicators was negative, that was a sell signal. And if price was weak enough to get down to the lower band, and one of those indicators was positive, that was a buy signal. And this system worked amazingly well, especially the sell signals. They had a very, very high accuracy. The buy signals had a little bit less accuracy because, as we all know, down is faster. So we would sometimes get some false buy signals because the price would accelerate so quickly to the downside that one of the indicators would still be positive. One of the indicators wouldn't have picked up the negativity that was developing in the market. But the sell signals were very accurate. And so we wanted to, there were problems with the system. And the problem with the system was that the bandwidth needed to change over time. If you're going in a sideways market, you might need 4.5 or 5%, maybe 6% bands. And if you're in a big, strong uptrend, maybe you needed a wider upper band and a narrower lower band. You know, you had to adjust these things. But we were doing these charts by hand with a pencil, right? So if you had to adjust it, it was a big problem because you had to redraw the whole chart. And that took hours. So I was after a way to automate the width of the bands. I wanted to be able to set the bands, have the market set the width of the bands. So I was an option trader at the time. Do we all know what an option trader is? So I was an option trader at the time, traded puts and calls on individual stocks. There were no index options yet. There were no index futures yet. There were no ETFs yet. There were just puts and calls on individual stocks. And I traded those. And I was very lucky in that I was a sort of hobbyist and was interested in electronics. So I had a very early version of a personal computer. We called them microcomputers in those days. And it ran an operating system called CPM, long gone. And I had a spreadsheet, a very early version of a spreadsheet. It was called SuperCalc. So I would, in SuperCalc, I would keep track of my options trading so that I could know what I had to do to buy or sell, what I had to do to hedge my positions and such like that. And one day, I copied the formula for volatility because when you're trading options, if you're going to be successful trading options, you have to have an understanding of volatility. You have to be able to calculate volatility, and you have to be able to make an estimate of future volatility. So I had some formulas programmed into this little spreadsheet to calculate volatility. And one day, I copied the formula for volatility down a row of data. And I saw that it was changing. Now, you say, well, yeah, duh, volatility changes. We all know that, but we didn't know that then. Right? We thought volatility was a property of a stock, like the rug is red or the ceiling is high. You know, IBM's volatility, we measured volatility using beta. We'd say IBM's volatility is 1.2. And that was it. We didn't expect that it would change. And, you know, I copied this formula for volatility down this column in the spreadsheet. I saw it was changing. And I said, well, maybe I can use volatility to set the width of the bands. And so you can see where that goes. You know, a couple of weeks later, I had Bollinger bands, and I was drawing them on the chart, and I was really happy because I no longer had to worry about how wide to set the bands. Now, what you're going to ask me is, why did you worry about how wide to set the bands? And the answer is very simple, because if you draw the bands, if you set the bands by eye, by hand, you allow your emotions into the trading process. If you're bullish, you'll draw the bands to have a bullish picture. And if you're bearish, you'll draw the bands to have a bearish picture. Right? But by switching to volatility to drive the width of the bands, out go the emotions, and in comes adaptivity. So the bands adapt to what's going on in the marketplace. That's the magic of Bollinger Bands. So the next question I'm asked is, why 20 and 2? So the default values for me for Bollinger Bands are a calculation length of 20 periods and a width of plus or minus 2 standard deviations. That's the calculation we used for volatility. So people ask me, why those values? And the answer is quite simple. Because they work. No, I'm serious. Why did we choose 20 and 2? Because it works. You know, it's now people have debated this idea of why a 20 or a 21 period moving average for a long time. Some people say that it's the number of trading days in a month. Some people say that it's the lunar cycle, because there's 20 or 21 days, 20 days in the lunar cycle. There's actually, in the US, because of market holidays, there's actually only 19 days in a lunar cycle. 19 trading days. The interesting thing is that it doesn't matter. 18, 19, 20, 21, 22, it's all more or less the same. And what do we call that? We call that robust. When you build a trading system, if you can vary the parameters of that trading system without changing the results of the system very much, that's what we call a robust trading system. And so it turns out that that's true for Bollinger Bands. 18, 19, 20, 21, 22. I use 20, you can use 21, you can use 18, you can use 19, it doesn't matter. At the end of the day, we'll have more or less the same results if we have more or less the same trading rules. But the glory of the Bollinger Bands for me is that I come to conferences like this, and I meet people like you, and we talk in between sessions and such like that, and you share with me how you use Bollinger Bands. And it's always new, it's always interesting. You've always made it your own. And that's the key to success, is to take these tools and use them in your own way so that it's a unique approach that fits your risk and reward criteria, your penchant for whether you want to be a home run hitter so that you have, one giant winning trade and you're willing to endure, a lot of small losing trades to get there, or whether you want to be like a production hitter. So you have many, many average size wins and just a few small losses. It's just a matter of trading style. It's a matter of your temperament, who you are and what you want to do. So that's really it. Bollinger Bands define high and low on a relative basis. That's all any trading band does. Whether they're Bollinger Bands or Keltner Bands or Stark channels or average true range channels or Donchian bands, they all do the same thing. They all define whether the price is high or low on a relative basis. You can then use that information to generate buy signals like we did with that old system, the Dow with advances and declines, up and down volume. Or you can use it in pattern recognition to find W bottoms or 3 pushes to a high. There's a lot of things that you can do. But that's really the story behind Bollinger Bands. And, they're tools that you can use in almost any way that you can imagine. I've seen people use Bollinger Bands as short as 5 periods and as narrow as half a standard deviation. I've seen people draw 1, 2, 3, 4 standard deviation lines above and below and plot multiple sets of bands on the chart at the same time so that it looks like, a exploding rainbow. But it works for them. And that's the glory of all of this, is that, these are just tools. And the challenge is for you